When the FT was in its infancy, the assets of UK banks were about 40% of GDP, and today that ratio has grown tenfold. As we've recently been painfully reminded, a specialization in financial services carries risks as well as rewards. And those risks will grow unless we put global banks and markets on sounder footing. If we just suppose, for example, that the UK's banks, that they maintain their share of global banking activity, and at the same time that financial deepening in foreign economies, particularly emerging markets, increases in line with historic norms, by 2050, UK banking assets could exceed 9 times of GDP, and that's just of the UK banks, and that says nothing of the potentially rapid growth of foreign banking and shadow banking here in London. Now, many would react to this prospect with horror. They'd prefer that the UK financial services industry be slimmed down, if not shut down. And in the aftermath of the crisis, such sentiments have gone largely unchallenged. But if it's organized properly, a vibrant financial services industry brings substantial benefits. Even today, financial services accounts for 1/10 of UK GDP and is a source of over 1 million jobs. 2/3 of those jobs are based outside of London, whether in asset management in Edinburgh, transactions processing in Bournemouth, or insurance in Norwich. Being at the heart of the global financial system also broadens investment opportunities for the institutions that look after British savings. And it reinforces the ability of UK manufacturing and creative industries to compete globally. Not to mention that financial services itself represents one of the UK's largest exports. More broadly, London's markets serve a vital global role. London acts as Europe's window to global capital, is a center of emerging market finance, and can play an important role in the financial opening of China. So the UK's financial sector can be both a global good and a national asset, and it will be if it's resilient. It's not for the Bank of England to decide how big the financial sector should be. Our job is to ensure that it's safe. The UK can host a large and expanding financial sector safely if we implement a reform agenda that extends well beyond domestic banking. Now, that's not to suggest for a moment that the focus on reforming domestic banks has been misplaced. Following the crisis, it was imperative to fix first the fault lines at the core of our system, with initiatives ranging from rebuilding the capital of the major UK banks and building societies to changing the structure of compensation and the responsibilities of senior officers. In tandem, some banks are now working to change their cultures. But reforms of global banking are far from sufficient, reforms of domestic banking are far from sufficient for a global hub such as London. And now's the time for a greater focus on what's needed for resilient international banking and robust global markets. This will require sustained international engagement because unlike the early days of the FT, the UK can no longer dictate standards. Rather than ruling the waves, we must spur collective action through international engagement, through a demonstrated commitment to openness and a promotion of better ideas, whether at the European level or at the G20 via the Financial Stability Board. More fundamentally, such engagement would be timely because globalization itself is under siege. Cross-border capital flows have fallen sharply since the crisis, and multilateral trade liberalization has stalled to the detriment of global prosperity. Now, if we're to stem the tide towards financial fragmentation in particular, we must make global finance more resilient, and that will serve both our national and global interests. So accordingly, I'm going to concentrate today on 3 core elements of the Bank of England's financial stability strategy, and they are creating resilient global banks, building robust global markets, and conducting central banking for those markets. These initiatives support a 4th leg of our strategy, which is improving the supply of finance in the UK. And you'll hear more about those supply-side initiatives aimed, for example, at rebuilding securitization and supporting SME lending in coming months. So let me begin with making international banks safer, which is, of course, fundamental to renewed globalization. To this end, a lot has been done. Global standards for capital and liquidity have been agreed. The major global banks, just the major global banks, have already raised more than $500 billion of new equity over the course of the last few years, and they're on course as a group to meet the exacting Basel III capital standards more than 4 years in advance of the deadline. In the UK, all major banks and building societies now have in place credible plans to achieve the Bank of England's thresholds for capital and leverage. Now, to finish the job over the next year, international regulators need to agree new rules for capital that's held in banks' trading books. We need to agree a simple leverage ratio, and we also need to agree a new guideline that governs the stability of banks' funding. Alongside these efforts to increase resilience, our focus will be on solving the problem of banks that are too big to fail. Systemic resilience depends on being able to resolve failing banks in a way that doesn't threaten the entire system. Fairness obviously demands that we end a system that privatizes gains and socializes losses. And simple economics dictates that the UK state cannot stand behind a banking system that's already many times the size of its economy. Moreover, without a credible means to resolve failing banks, regulatory balkanization will continue as national regulators seek to protect their own interests, thus threatening the efficient operation of international financial system and accordingly London's competitiveness. So in order to avoid these risks, we need to make the resolution of global banks a real option. This will require coordination and cooperation between authorities across multiple jurisdictions, and this will only work if authorities are confident that global resolutions will deliver the domestic financial stability and protect local banking services. Now, we need to structure cross-border cooperative agreements, and these will help, but the fine words in those agreements need to be backed up by harsh economic incentives. And in this regard, operating structures of banks must be made consistent with resolvability, and above all, banks must have substantial loss-absorbing capacity that cascades through their group structures. Now, at the St. Petersburg summit in September, G20 leaders mandated the FSB to develop these proposals. And the Bank of England is now working intensively with other authorities and with some in the financial services industry to do so. Our aim is to finish this job by the time of the next G20 summit in Brisbane. Now, by increasing the resilience of banks and tackling too big to fail, we can help make London a safe global banking center. But as I've argued a moment ago, that's far from sufficient. We also need to dramatically improve the resilience of markets. And in order to do so, we need first to consider how those measures, some of the measures I just talked about, to improve the resilience of banks, how they've affected the functioning of markets. It's true that the combination of higher capital ratios and higher capital to be held against trading books, the new leverage ratio that's to be agreed, and in some cases in the US, for example, the proposed Volcker rule and restrictions on proprietary trading, the combination of those and other measures have already combined to reduce dealer inventories across a range of securities. With dealers less willing to deploy capital against large market moves, volatility has increased and liquidity has fallen when there's been shocks such as that which occurred over the summer over the potential shift in U.S. monetary policy. Now, on the other hand, with limited proprietary positions, banks generally emerge from this summer of stress unscathed, and certainly no one wants to return to the days when major dealers' trading books were crushed under the weight of worthless structured products. So to strike a balance between making banks safer and maintaining adequate market liquidity, we need to draw some lessons from the financial crisis, particularly lessons from what happened when contagion from stressed banks spread rapidly through the global financial system via concerns about counterparty credit, via liquidity hoarding, and ultimately mass deleveraging. It was in this environment that core funding and OTC derivative markets seized up and panic quickly followed. By contrast, markets that had greater transparency, markets that had more robust trading and settlement infrastructure, such as equity markets and foreign exchange markets and exchange-traded futures markets, performed much better. Prices in these markets were not always to participants' liking, but importantly, these markets remained open and they remained functioning. So our argument is that London should, given our position, London should lead the way in ensuring that fixed income and derivative markets meet such standards. At the FSB, the Bank of England is helping to devise reforms that increase transparency, that build more robust infrastructure, and encourage better collateral management. And since collateral is at the cornerstone of all this and goes to the heart of central banking, allow me to spend a few minutes on it. What collateral does is it reduces risk between market participants, and it also, at the same time, supports market-based sources of credit to the real economy. Collateral is central to the functioning of OTC derivative markets. Remember, these are, in notional terms, $600 trillion markets, and it's central to the funding of the shadow banking system. And since market-based finance, such as securitization, needs good collateral to grow sustainably, its availability directly influences the supply of finance to British households and businesses. Now, the use of collateral isn't without risks. When collateral values rise, fixed haircuts allow banks and non-banks to borrow more, and that pushes up asset values further. Of course, the reverse is also true. And this inherent procyclicality exposes the system to sharp corrections, which, in the extreme, lead to a sell-off in financial markets, leading to higher haircuts, a run on repo, and ultimately a market seizing up. So to reduce those risks, the FSB, at the Bank of England's encouragement, has proposed minimum regulatory standards for collateral valuation and management, as well as a schedule of proposed numerical haircut floors on repo transactions. The FSB will soon require central clearing of standardized derivatives transactions to limit exposures between counterparties, and it'll promote the efficient netting of positions and moderate, and all of this together will moderate collateral cycles. Now, new minimum capital and margining requirements for bilateral OTC trades will also protect banks from defaults of their counterparties and also reduce this procyclicality at the core of the system. The sum of that is to help keep markets open. So the combination of these reforms, though, means that institutions, particularly banks, need both more collateral and they need to manage it better. And we're confident that financial markets know how to innovate and will do so. Already we're seeing investor expectations for liquidity change, and models for risk intermediation are expected to evolve in ways that reduce balance sheet usage. But let me get to my third point before concluding, which is what do central banks do in this environment, and we clearly need to keep up. In particular, we can catalyze more efficient and effective private collateral management by backstopping private markets. Now, going back a bit before the launch of the FT, 140 years ago in Lombard Street, Walter Bagehot, by the way, no central bank speech is complete without a Bagehot reference, expounded the duty of the Bank of England to lend freely to stem a panic and make loans on, and I quote, everything which in common times is good banking security. Bagehot was particularly scathing on the bank's failure at the time to state a clear and sound policy on this general topic, writing, until we have on this point a clear understanding with the Bank of England, both our liability to crises and our terror at crises will always be greater than they otherwise would be. 140 years on, the bank has a clear and sound policy. It's set out in the revised Sterling Monetary Framework, which has just been published. The new framework builds on the lessons learned throughout the crisis, and it draws on the recommendations of the modern Badgett, Bill Winters, in his review of the system. Bill, I think you're here. I'm not sure you. It's a compliment from the central bank. I'm going to use more than 5 words to describe our approach in a moment, but I'm going to use 5 right now, 5 simple words to describe our approach, which is that we are open for business. The new Bank of England facilities are not ornamental. They're there to be used. They're there to be used by banks to access money and high-quality collateral. We're offering money and collateral on longer terms. The range of assets we will accept in exchange for those offerings will be wider. We'll extend that range of collateral to raw loans and, in fact, to any asset we're capable of assessing the risks of. The use of our facilities will also be cheaper. In some cases, the fees are being more than halved. And banks can be confident that when they want to use our facilities, they will be allowed to access them. Because we are now both the supervisor in the form of the PRA, because we're both the supervisor and the central bank, the strong presumption is now that if a bank meets the supervisory threshold conditions and has signed up to our framework, it will be able to use our facilities. Our discount window will be open every day for those firms requiring a bespoke facility, and it will have lag disclosure. Its price will be lower. We will hold monthly repo auctions to provide predictable and regular access to high-quality collateral in exchange for a very broad range of collateral. And at times of actual or prospective stress conditions, we stand ready to provide cheap, plentiful money through more frequent auctions. Now, none of this means that financial institutions are excused from the need to manage their balance sheets prudently. But as Bill Winters himself observed, more exacting liquidity requirements mean that the conditions for using central bank facilities can be less stringent and therefore more effective. And this is one example of the synergies that arise from having supervision within the central bank. So with our announcements today, we think we're building a liquidity framework for the markets of tomorrow. Now, in the markets of today, initial usage of these facilities is expected to be limited. And that's because the MPC stock of asset purchases and the existence of the funding for lending scheme currently provide all the liquidity and collateral that the sterling system currently needs. But as those operations are wound down over time, we expect to see banks making increased use of our permanent facilities. Now, we think today's announcement is significant. It certainly marks an end of a process of innovation throughout the crisis and the response to Bill's report. But it doesn't mark the end of history for the Bank of England's market operations. We'll continue to evolve our approach as the financial sector changes, and in particular, we need to think about and answer 2 big questions. And the first is whether the bank should allow non-banks to access our regular facilities. After all, our responsibilities for financial stability run much wider than the banking sector, and institutions that play a central role in markets, such as broker-dealers or financial market infrastructure, are the obvious candidates. One thing to note, though, is if the scope of access to central bank facilities increases, the scope of regulation can be expected to expand in a proportionate manner. Secondly, the second question is, given that we host an international banking system as well as global markets, we need to think about to what extent the bank should provide liquidity in currencies other than sterling. As markets evolve and banks and markets here may need backstops in currencies other than sterling and in time zones other than those served by the Fed and the Bank of Japan. At present, we can supply limitless quantities of sterling, but we have to rely on other central banks for access to their currencies. In response to the crisis, we built up a network of swap agreements amongst the major advanced economy central banks in order to provide that. And recently, we've recognized that that network of swap agreements shouldn't necessarily be limited to the G7 economies. In June, under my predecessor, the Bank of England signed such an agreement with the People's Bank of China. And this reflects the growing international role of the renminbi. It dovetails with the possibility of establishing a renminbi clearing bank here in London, and it's also consistent with our broader policy of openness to hosting foreign wholesale banking activities, which could include, could be extended to branches of Chinese banks. Now, helping internationalization of the Chinese currency is a global good, consistent with London's historic role. But I want to assure you that the bank will act in a manner that's consistent with its domestic responsibilities. As my colleague Andrew Bailey mentioned last week, our risk appetite for foreign branches will largely be determined by whether their activities in the UK are covered by credible recovery and resolution plans. As always, renewing globalization and building resilience go hand in hand. So let me conclude by summarizing. After perhaps the worst financial crisis in the FT's long lifetime, it's reasonable to expect now that financial services will again grow in importance. The process of financial deepening in emerging markets is only just beginning. In Europe, there's a strong case for greater reliance on market-based finance relative to weakened banks. The UK stands to benefit from these trends because of London's place at the heart of the global financial system. And properly structured, this will create investment opportunities for British savers, reinforce trading ties for UK firms, and improve access to credit for the real economy across this country. London's international markets, in turn, provide vital services to the global economy. And those benefits on both sides will be greatest as part of an open, integrated financial system. The bank's task, the Bank of England's task, is to ensure that the UK can host a large and expanding financial sector in a way that promotes domestic financial stability. Only then can that sector be both a global good and a domestic asset. To those ends, we're working to complete the job of making banks more resilient and tackling too big to fail. We're making markets more robust in order to turn shadow banking from a source of risk to a pillar of resilience. And we're changing how we backstop private firms' liquidity management. And all of these efforts will help set the stage to further improve the supply of credit within the UK. So let me finish by putting my point a little more succinctly in the style of the FT 125 years ago. The Bank of England, this is my pitch to be a leader writer, the Bank of England is the friend of resilient banks, continuous markets, and good collateral, and we're the enemy of taxpayer bailouts, fragile markets, and financial instability. Our circle of friends, like the FT's readership in its infancy, is currently small, but it's expanding. And as it does, the UK will help to renew globalization to the benefit of all. Thank you very much.